In this video, we are going to talk about dividend stocks to buy before they rebound. So before starting this video, please like this video and subscribe to this channel for our future updates. Holding on to investments over a period of time that is greater than 1 full year is an example of a long-term investing plan. Holding assets such as bonds, equities, exchange-traded funds, ETFs, mutual funds, and other investment vehicles is a component of this strategy. Individuals who take a long-term approach need to have self-control and patience. This is because investors need to be able to tolerate some level of risk while they wait for greater profits in the future. Here are several equities that you should consider purchasing before they start to rebound. Enterprise Products Partners. Enterprise Products Partners, in contrast to the majority of other equities, did not see a decline in recent months. The shares of the large energy midstream corporation have increased by over 18% since the beginning of the year. When the whole dynamics of the oil and gas business are taken into consideration, this substantial gain makes perfect sense. Concerns of a possible invasion of Ukraine by Russia have contributed to the surge in prices. On the other hand, as the economy of the world begins to recover from the effects of the COVID-19 epidemic, there has been a rise in the demand for oil and gas. Because of its pipelines, natural gas processing facilities, and storage facilities, Enterprise has been one of the most significant companies to profit from these favorable winds. It should also profit even more in the event that the stock market maintains its recent bounce and economic worries continue to diminish. But even if that isn't the case, Enterprise is a stock that ought to perform admirably regardless of what the market does. A generous dividend return of 7.2% is provided by the organization. Enterprise has, over the past 23 years in a row, expanded both its production and its distribution. There are not a lot of high-yield dividend stocks that have a track record that is nearly as good as this one. Medical Properties Trust. The stock of Medical Properties Trust has not done as well as it had been doing. Even though they started to make gains in the middle of March, the company's shares are still down approximately 9% for the year. The core operations of the company, on the other hand, haven't been affected in the least. That fundamental enterprise consists of buying and renting out medical facilities. Around 440 different facilities are included in the portfolio of Medical Properties Trust, which is a real estate investment trust, REIT. Roughly 60% of these facilities are located in the United States, with the remainder spread across 8 other nations, the majority of which are in Europe. The ups and downs of the stock market have little effect on the amount of money that Medical Properties Trust makes from its leases, as you might assume. Inflation rates that are higher shouldn't present much of a challenge either. More than 99% of the leases held by the REIT include rent increases that are calculated according to the Consumer Price Index, CPI. REITs are well known for the dividends that they pay out. On this particular front, Medical Properties Trust does not disappoint. Its dividend yield is currently just about 5.5% at the present time. The dividend payout has been raised for the past 8 years in a row by the corporation. Verizon Communications. Verizon Communications is a high-yield dividend company that has a quality that very few other stocks can claim to have. It is considered to be one of Warren Buffett's personal favorites. Berkshire Hathaway's portfolio includes the 8th largest stake in the multinational telecommunications corporation. Should you invest in Verizon simply because Warren Buffett likes the company? Of course not. Nevertheless, it's a good idea to at least analyze what an investor like the Oracle of Omaha could find appealing about Verizon. This will help you make a more informed decision. The dividend is surely one of the highlights. The dividend yield on Verizon shares is greater than 5%. The dividend paid out by the corporation has been raised for the past 15 years in a row. As long as Verizon maintains a payout ratio of less than 48%, it should not be difficult for the company to continue its winning streak. Yes, it's likely that Verizon won't produce blisteringly fast growth. On the other hand, the corporation might have better development potential than you might think it does with its high-speed 5G network, particularly in terms of expanding further in the market for residential internet service. There is more positive news than negative news regarding Verizon at this time. Brookfield Renewable Partners. The loss that Brookfield Renewable Partners has incurred thus far in the beginning of 2022 is less than 10%. If you look at the share price from the beginning of 2021, though, you'll see that it's fallen more than 30% below its all-time high. This round of selling might be a little excessive. Both Brookfield Renewable Partners and its younger sister, Brookfield Renewable Corporation, which both represent ownership in the same entity but have different tax considerations, provide a front-row seat to the ongoing growth in the clean energy space. Brookfield Renewable Partners is the older of the two companies, and Brookfield Renewable Corporation is the younger. The most interesting thing about this place is what the future holds, particularly in light of the ongoing drive for green electricity all around the world. Notably, Brookfield Renewable Partners has just reached an agreement to buy Urban Grid, which will triple the amount of renewable development pipeline that Brookfield has in the United States. Despite the fact that it seems investors have lost interest in this clean energy play, the company is still able to capitalize on the larger trend toward alternate forms of energy. And while you wait for it to take advantage of this tremendous chance for long-term gain, you can still earn a dividend yield of 3.6%, which is considered to be rather generous. Clearway Energy Company. The price of a share of Clearway Energy has dropped by around 15% from its most recent high. The sustainable energy producer's long-term growth prospects have improved in recent months, but despite this, there has been a sell-off of the company's shares. Because of this, investors now have the opportunity to purchase shares of this renewable energy company at a valuation that is more favorable. During this procedure, they have the opportunity to lock in a higher dividend yield, which is now at about 4.1%. Clearway is certain that it will be able to locate sufficient chances that will entice it to invest the remaining capital. According to their projections, those potential future investments will increase their CAFD to $2.15 per share. Taking this into account, its valuation at the current price is probably closer to 15 times forward CAFD. Because of Clearway's increased cash flow, the company now has a better idea of how it might increase its dividend. It is now aiming for dividend increases that are closer to the higher half of its target range of 5% to 8% annual growth through the year 2026. In the meantime, it ought to have enough of ability to continue raising its CAFD and dividend in the future, given the expenditure that is required to lower the possible impact of climate change and reduce the amount of carbon emissions. Clearway Energy is now selling at a lower valuation, and its dividend yield has increased as a result of the recent sell-off. When you consider that, in addition to its growth possibilities, it appears to be a stock that would be a good choice to acquire during the present decline in the stock market. Ford Motor. Ford seems to be putting the patience of investors to the test this year after delivering a remarkable gain in 2021. Since the middle of January, the stock of the global automobile giant has fallen by close to 30%. Instead of the great things Ford has planned for 2022 and beyond, the company is already dealing with issues such as scarcity of semiconductor chips. In point of fact, Ford has upgraded its forecast and now anticipates that its adjusted profits before interest and tax, EBIT, would increase by anywhere from 15% to 25% in this year. Strangely, the market appears to have ignored this, as well as Ford's confidence about 2022, which was driven by robust demand for the company's new vehicles, particularly the all-electric version of its F-150 pickup truck, which has also been America's best-selling truck for several decades now. This will be the first year that Ford begins delivering its F-150 Lightning pickup trucks, and the company is so inundated with pre-orders that it is increasing production capacity by 50%. In the meantime, customer interest in Ford's electric SUV Mustang Mach-E remains at an all-time high. In January, Ford also introduced a new model to its lineup, which was an SUV called the Bronco Raptor. Given everything that's going on, it might only be a matter of time before Ford stock makes a comeback as the company works to dominate the competitive electric vehicle (EV) market. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.